Welcome to the deep dive. Today, we're looking into something pretty specific. It's called Mansi's trading tip number 60.
That's right. We've got this concise set of trading rules.
Yeah, focused on, well, how a stock's price relates to its moving averages, the 50-day and 200-day ones.
And also some short-term candle patterns thrown in there.
So our mission here really is to unpack Mansi's strategy.
Exactly. Break it down, see what makes it tick, and, figure out what insights it might offer you as you navigate the markets.
Okay, let's get into it. The core idea seems to be these moving averages, the 50-day and 200-day. That's the starting point.
Absolutely. That's the fundamental premise Mansi lays out. Basically, where the price is relative to those averages tells you the overall sentiment for that stock.
Sentiment like bullish or bearish.
Precisely. These averages, they smooth out the price action over time, right? So they give a clearer view of the underlying trend.
Okay, so walk us through it. If the stock's price is trading below both of those averages.
If it's below both the 50-day and the 200-day, Mansi says the outlook is bearish.
Bearish, okay.
Yeah, it suggests the longer-term trend is down. That kind of sets a negative bias for any potential trades.
Right, and the flip side, price is above both averages.
Then the sentiment flips. It's considered bullish.
Bullish.
The implication is that the longer-term trend is pointing upwards, at least according to this specific method.
So that first check above or below is like the main filter for everything else.
You got it. It's the lens you use for all the subsequent steps in this strategy.
Okay, let's dig into the bearish scenario then. Price is below both moving averages. Mansi seems skeptical about green candles here.
Yeah, that's an interesting point. Mansi basically suggests you shouldn't really trust upward movements, the green candles, when the overall context is bearish, below those averages.
Why not?
Well, the thinking seems to be that any rallies you see are probably just temporary bounces, little upward blips within that bigger downtrend.
So not reliable signals to buy.
Exactly. They're viewed with suspicion in that bearish environment.
Okay, so if you're ignoring the green candles, what does trigger a potential short trade? Like betting the price will fall further.
There's a very specific trigger for going short. It's when a 5-minute candlestick closes below the low price of the previous trading day.
Ah, okay, so you need that short-term confirmation.
Right. It's not enough just to be below the moving averages long term. You need that immediate breakdown on the 5-minute chart.
And risk management, crucial part. What about the stop loss?
Also very specific, for that short trade, the suggested stop loss is the high price from the previous day.
Previous day's high. Okay.
The idea is if the price climbs back up and breaks above that previous high, your bearish assumption might be invalidated. Time to get out.
That makes sense. It's a clear line in the sand to limit losses. Okay, let's switch gears. The bullish picture. Price is above both the 50-day and 200-day averages.
Right.
Mansi has a similar distrust, but this time for red candles.
Yeah, it mirrors the bearish view. In a bullish setup, Mansi doesn't put much faith in the downward price movements, the red candles.
Same logic, just reversed.
Pretty much. The thinking is, in an overall uptrend, dips are likely temporary. Other traders might see them as buying opportunities.
So those pullbacks shouldn't necessarily scare you out of a long position.
Correct. They're not seen as reliable signals that the uptrend is over, just pauses within it.
All right, so if you're discounting the red candles, what's the signal to actually go long to buy the stock?
It's the mirror image of the short trigger.
Yeah.
You look for a 5-minute candlestick to close above the high price of the previous trading day.
Above the previous day's high.
Okay, that's your short-term signal that the upward momentum is kicking in again, aligning with that bigger bullish picture from the moving averages.
Another confirmation step. Avoids jumping the gun, maybe.
Could be the intention, yeah. Helps confirm the move is real.
And the stop loss for this long position, where does that go?
Consistently, it uses the prior day's range. For a long trade, the stop loss is placed at the low price of the previous day.
Previous day is low. Got it.
Same principle. If the price unexpectedly drops and breaks below that low, it's the signal to cut your losses on the long trade.
Okay, great. We've covered the core idea, the bearish rules entry, stop loss, and the bullish rules. Let's try and synthesize this. What are the key takeaways for you?
Well, what stands out is how it combines different time frames. You've got the longer view from the 50 and 200-day averages setting the overall trend bias.
Right, the big picture.
And then you zoom right in to the 5-minute chart, looking at the previous day's high or low for a very specific short-term entry trigger.
So it tries to get you trading with the main trend, but gives you a precise moment to act.
Exactly. It aims to align your trades with that prevailing current, but with a concrete action point.
And it's very rules-based, isn't it?
Mm-hmm.
Seems like it could take some emotion out of trading.
That's definitely a potential appeal. It lays out clear steps.
No.
Check the averages, wait for the 5-minute signal relative to yesterday's range, set your stop. It's systematic.
Yeah. And we saw how it has that built-in bias, right? Skeptical of counter-trend moves based on where you are relative to those averages.
Precisely. It leans heavily on trading in the direction indicated by the moving averages.
And the stop-loss component is always there. That risk management piece is baked right in.
Absolutely critical. It's not just about getting in, it's about having that predefined exit if things go wrong. Proactive risk control.
Okay, so let's recap the core tip. Mansi uses the 50-day and 200-day moving averages to decide if the overall vibe is bullish or bearish.
Step 1.
Then, if it's bearish, below averages, look for a 5-minute candle to close below the prior day's low to go short. Stop loss goes to the prior day's high.
Mm-hmm.
And if it's bullish, above averages, look for a 5-minute candle to close above the prior day's high to go long. Stop loss at the prior day's low.
That captures the mechanics perfectly.
All right, so here's something for you, the listener, to maybe pound on. Think about this approach using a longer-term filter like moving averages, with just smooth price data to show trends.
And combining that with a really specific short-term confirmation signal.
Right. How might that fit into how you think about analyzing market moves? What are the strengths you see in a purely rules-based system like this one Mansi outlines?
And maybe also consider what could be the potential drawbacks or the challenges applying such a defined set of rules in a market that's, well, often messy and unpredictable.
Good points. Something to think about.